Hi, I'm JJ Kovac, author of recent work delaying supplier payments to increase buyer profits. So this project started several years ago in discussions with one of the co-authors, Morgan Swink, and the prevalence of slow paying in popular press, where firms are increasing their payment terms to suppliers. At the same time, Morgan noted that in a recent work he had done, he found an association between shorter payment terms and better performance, which contradicts the notion that you can increase your working capital and use those funds by extending payables to further investments and other revenue generating activities for the firm. So I brought in Mo Rodriguez from finance to hash through why firms would extend payables, what do they use those funds for, because there's an inherent tension there that we came to. Ultimately, does extending these payables lead to increased profitability? On the one hand, you have freed up cash that you can use for a lot of internal projects, potentially reduce debt, other revenue generating activities. But on the other hand, this may upset your supplier base. So you may have some unintended consequences on dealing with upset suppliers, either through cost or quality or supplier turnover. And then we started thinking, well, what are some things that may mitigate these relationships between extending payables and financial outcomes? And Walmart immediately came to mind. Not that they're guilty of doing this, but if a company like Walmart were to extend payables to their suppliers, there's not a whole lot these suppliers can do because they have so much market power. They're really big compared to a much smaller retailer who may face larger consequences from the supply base. And then additionally, what about financial strength? If you're a firm that's on the brink of bankruptcy and you decide to extend payables terms to your supply base, that's a pretty negative signal. I would imagine that there could be a lot of angst, and these suppliers may bail on you instead of being subject to increased or no payment from a financially distressed firm. So the ultimate question is not only how does extending payables, slow paying impact profitability, but does market share, market power, and financial stability, financial strength, do these moderate this relationship in any way? So we collected quarterly data from all manufacturing, wholesale, and retail firms from CompuStat from 1980 to 2019. So for 40 years, we have about 400,000 firm quarter observations, representing about 10,000 unique firms from 216 different four-digit based SIC code industries. From this data, we looked at firms trailing 12-quarter average days of payables, as well as the standard deviation in those 12 quarters. And then we looked at this next 4 quarters of data for their days of accounts payable. And we flagged any firm that the next 4 quarters was at least one standard deviation higher than the prior 12 average for each of the subsequent 4 quarters. So they've extended payables by at least one standard deviation, and that's a sustained increase for at least a year. We also looked at a 1.5 and a 2 standard deviation increase in payables, and the results were consistent. We elected to stick with 1 standard deviation simply to preserve a larger sample size. We found about 6,500 instances in our data set where firms abruptly and substantially increased their payment terms, which would represent about 3,000 distinct firms. So what we next had to do was build a sampling of control firms to compare against these firms that extended payables, which we'll call the treatment group, right? And this sampling of control firms needed to be as similar as possible to the treatment group so that we could compare the profitability differences between the two. So first, the firms that were used in the control group had to be in the same industry, 4-digit SIC code, at the same time that a payables extension occurred by the treatment group firms. We also wanted to ensure that they were the same as far as market share, so percentage of industry-wide revenue, as well as their Altman Z-score for financial health, which is Altman Z is often used to predict future bankruptcy. So it's a good measure for the financial strength of a company. Similarly, we wanted firms to have comparable days payable policy prior to the extension. So by doing this, we're ensuring that the firms that we're comparing the treatment group to were essentially the same as far as relative market share, financial strength, and their payment policies toward their supply base in aggregate. We next wanted to make sure that these control firms also were financially similar. So they had to have the same prior quarter return on assets, as well as an average of the 4 quarters to mitigate any seasonality concerns or 1 quarter changes in profitability. And then we looked at the prior 4 quarter average ROA compared to the 4 quarters before that to see if there's any increasing or decreasing trends in ROA. So if firms were exhibiting decreasing trends in ROA and they had relatively low ROA, they were compared to firms that had similar decreasing trends and similar ROA performance. So by doing this, we're ensuring that the treatment group of firms that extended payables are compared to other firms that are very similar in nature. When we do this matching, we base it on the shortest Mahalanobis distance to the most similar firms. So this Mahalanobis distances takes these all these continuous variables for payables and ROA and market share and consolidates them into one metric that can be used for similarity comparison. We also matched compared to the 3 most similar firms. Again, this reduces the sample size a little bit, but the results were similar. Alternatively, we matched based on propensity scores, diagonal covariance weight matrices, Euclidean distances between measures. All were similar findings, yet the Mahalanobis distances yielded the best sample balance, and so that's what we chose to use. Details of all that are in the appendix. The final sample, once we were able to match firms with a good balance, was about 1,900 observations with about 1,200 unique firms. So in average, each firm extended payables, more than once. We considered ROA as our proxy for abnormal performance. We also looked at return on equity, which was consistent results there as well. When we're looking at the abnormal profits, we're looking at a difference in differences. So we're looking at the next 4 quarters average ROA compared to the prior 4 quarters ROA before the extension occurred. So what's the change there? Did the profits go up or did they go down, or were they pretty consistent? And then we compare that to the same change in their control matched sample. So whatever firm was most similar to them, what was their post minus pre 4-quarter average ROA from an extension event happening. So compare those difference in the differences to determine the abnormal profits. So what did we find? Well, the main conclusion is that extending payables on average yielded a negative profit impact. So firms that extended payables had lower subsequent profits. And firms that had higher market power or were financially stronger were less impacted. So under no circumstances did we find that market power or financial strength were able to tip the scales so that extending payables yielded to better abnormal profits. It was always less, but firms with market power or financial strength had less negative impacts. When we initially presented this to industry executives, they weren't surprised at all. They said, well, if we delay our suppliers' payments, then we expect poor service, poor quality, perhaps turnover. We expect bad things to happen. And so I don't necessarily think that I should expect, anything different than what you found. But that's not what the academic community found. They weren't convinced. First, we had to prove that our results were robust to a lot of confounding effects. And then the question came up, okay, if they freed up all of this cash, where does it go? What are they doing with it? And then secondly, you're saying that the profitability is negative, negative abnormal profits. Why? What specifically is happening to their firm that is causing the profits to go down? So first, where did the cash go? Well, we've found evidence that firms that extend payables have abnormally higher subsequent accounts receivables. So they're passing along some of this extension in payments to their suppliers to extension in payments from their customer base. We also found increased inventory and cash on hand. So both of those were abnormally high. Last, we found increased investments in R&D and capital expenditures. So they're using this money to pass to their customer base in payment terms, improve inventory position, increase cash, increase investments in R&D and capital expenditures. Contrary to expectation, we found that they actually increased short and long-term debt. We would have expected they would have used some of this increased capital to pay off debt, but that wasn't the case. It appears to be an extension in payables is part of a larger overall strategy to increase cash for investments. And lastly, we found no substantial impact on interest expense. So they weren't using this to trade high debt or high interest expense debt for low interest expense debt at all. And none of these effects on the use of the capital were moderated by either of the moderators' market power or financial strength. So it didn't matter if you were a big firm, small firm, healthy firm. Essentially, you were using these cash from extended payables in the same manner. Now, the next question is, why were profits impacted? So we expected to see a negative cost of goods sold. So meaning that the cost of goods sold would have increased at some, but we didn't find evidence of that at all. So there was no difference in abnormal cost of goods sold for firms that extended payables compared to firms that didn't. But what we did find is increased SG&A costs. So their sales general administration costs are going up, and they're not going up as much for firms that have high market share. And the question is, why is their SG&A costs, why are they increasing? And so we next looked at their supply base, and we found that firms that extend payables have abnormally higher percentage of turnover in their supply base, meaning that they are losing and replacing suppliers faster at a higher rate during periods of extending payables than firms that don't extend payables. And this effect is also moderated by market share, such that the more market powerful firms experience less supplier turnover. So in sum, we found a negative impact on profitability. So firms that extend payables have lower abnormal profits subsequent to the extension. And this is worse for firms that have poor market share or are financially not healthy. Now, what could we do going forward in the future from a research perspective? Well, we were limited by publicly available financial data. So we don't know if these extensions and payables were mandated or were they negotiated, under what conditions this happened. We don't know the motivation behind the extending payables. What was the purpose for doing so? What were the anticipated outcomes? What were the realized outcomes? So all of this type of information will be better suited for more of a survey-based approach, approaching companies to find out, how they're managing their payables policies and why. For practitioners, I would argue that you need to consider your supply base before you extend payables, because you can have some negative impacts that you weren't expecting. And even the most powerful firms, the most financially healthy firms, aren't immune from a negative relationship to profitability. So if you're in industry, then you need to take caution when extending payables because your supply base matters. So thanks for listening, and hope you check out and enjoy the research.